Okay, good morning, ladies and gentlemen. Welcome to our first delayed delivery hall session on the future of climate. Just want to make a huge apology for the difficulty everyone's had getting in this morning. I know it was chaotic. Thank you very much indeed for your patience. So we're starting a little late. We'll run a little late and hopefully catch up by lunchtime. So just very grateful for your patience. Turning to climate. So climate has moved from a niche to a core allocation, but capital's now far more demanding on both impact and returns. So this conversation today is about where money is really going, how founders build genuinely investable climate businesses, and hopefully what London and Europe need to do to stay competitive over the next decade. So our panel spans early stage venture, growth capital, and company building, and hopefully we'll be asking them to go beyond the buzzwords to find out what they're actually backing and where the future lies today. So Caritta is going to moderate this panel and introduce from there. So thank you, Caritta.
Thank you so much. Well, good morning. I'm happy to see, I will say so many of you because I've seen the queues outside. So you made it. Thank you for being here today. We're having a very exciting panel today about the future of climate. But I think before we dive into the topic and the questions, I would love to, of course, go around through our amazing speakers here and for each of them to give a brief introduction. Just to start briefly, my name is Caritta. I work for a Swedish-based early-stage VC fund, but I'm based in Helsinki. We invest across the Nordics and Baltics into early-stage companies around climate, circular transformation, and cybersecurity, among that. And together with me here, if we start with Parekh, maybe you can just give a brief intro of yourself.
Sure. So I'm Parekh Sheehan, founder of the Environmental Technologies Fund. We invest around Europe in typically digital companies that are scaling up rapidly and delivering very positive environmental impact. And I've done this for more years than I'm likely to want to admit to you without getting to know you. I've been in venture capital forever, really.
Hello, I'm Nicky, founder of Carbon 13, and we build companies from scratch, literally from scratch. Sometimes describe it as Love Island for climate, gives you a feel. And then we also invest, so we've built around 350 companies and invested in over 100 of them.
Hi everyone, great to be here. My name's Rahul. I'm a partner at 2150. We're an early and growth stage venture capital fund investing in companies that are reimagining the built environment. We have about $500 million under management, and we're investing out of our second fund.
Hi everyone, great to be here too. I'm Reema. I'm part of P Capital Partners. We're part of the M&G investment group, and we're a credit fund. Investing out of a growth fund, which is just under 200 million, and we have about 5 billion under management.
Perfect, thank you. So now to really kickstart, I mean, climate tech was already the consensus allocation back in the 21 and 22, but obviously the whole macro has shifted, the deployments have gotten more selective, and now even the EU has labeled or rebranded climate as the clean industrial deal. So I would love to ask this question from all of the panelists, basically, starting with, let's say, with Parekh. Is climate still a venture-backable category at scale, or has it very much dissolved into energy and project finance in general?
I think there's still huge need, and there's therefore still a huge market. And it's not dissolved. Actually, these things you mentioned, sovereignty, the need for energy transition more acutely because of conflict, they're propelling the industry, and there's more specialization. That's a good thing because it's maturing. So no, I think it's blossoming actually. We're busier than ever. Great.
Nicky, what do you think?
Yeah, I mean, the space has been played since Clean Tech 1.0, then we saw a rebrand, Climate Tech, and then some voices saying that Climate Tech was dead. And actually, when you dig a little bit under the surface, you can see, as you said, that there's a tremendous amount of activity, sometimes under a different branding, whether it be supply chain resilience, energy independence. I think one of the lessons we can maybe learn from Clean Tech 1.0 is we can see some capital concentrating at later stages at the moment, but we certainly haven't solved the problems to reach net zero by 2050. So where we play is at the very earliest stages and making sure that we keep priming that funnel.
Rahul?
Yeah, sure. I think climate hasn't stopped becoming venture-backable. I think it's just stopped becoming venture-backable just because it's climate. And I think in 2021, 2022, a lot of companies were funded because they had the right climate narrative. Now they need the right customer, the right capital stack, the right margin profile. And now, increasingly, climate companies are not selling climate, right? They're selling, lower energy prices. They're selling more industrial efficiency, optimization, automation. And so I think the climate label doesn't matter anymore. I think it's more about the businesses that are in kind of, real assets in energy and industry that have, climate outcomes embedded within the business model.
Agree with what's been said. In particular for us, because we are a credit fund, we look at growth assets, but through credit as an instrument. And for us, what we're seeing in climate is very much venture-backable, but there are also a lot of asset-heavy, real asset businesses that have massive hardware, require physical assets, and credit kind of solves for that and plugs a gap that sometimes VC or private equity infrastructure style funds can't.
Perfect. I mean, Nicky already touched briefly about the clean tech 1.0, but Patrick, I mean, ETF partners, you have already invested for more than 2 decades in sustainability. So, I mean, much before it was ever really fashionable. But are there any specific lessons you could share about the clean tech 1.0 that you believe that have been ignored right now? And which mistakes do you see are still repeating?
Where to start, right? Of course, there was a huge flowering of interest in climate investing 5 years ago or so, and whenever that happens, there's going to be fallout, right? At the time, I said I thought half of the venture companies starting up focusing on climate would fail. I still think that's true, but that doesn't mean the sector is failing. Actually, the sector is growing from strength to strength. The words are interesting, and the misuse of words are interesting. Climate, to my mind, isn't a sector anyway, right? Climate is a shorthand for an outcome we're trying to achieve that covers many sectors. And we look really carefully at where we can play within the constraints of a venture capital fund, right? So think of a venture capital fund as a scalpel often being used by new climate funds as a mallet, right, to attack every sector. And it works really well where we can deliver rapid impact through scaling companies. And so that's what we focus on. And there it works incredibly well still. So if anything, we're seeing now, because there's also been a wave of deep tech investing, and people would say, well, deep tech isn't climate then, is it? To which I say, I don't understand, right? We're seeing great technology companies blossoming, delivering revenue and growth and positive impact. And that's a tremendous opportunity for us, which we're focusing on acutely, actually.
I think that's probably, if there's going to be any good messages, I loved when you said is that climate should not be looked as a sector, but rather as an outcome overall. And Nicky, you invest, of course, in with Carbon 13 in very early stages, if I may say. And you already mentioned, of course, the Clean Tech 1.0. But are there anything you might add from the very pre-seed early stages, like some of the lessons that you could share from the Clean Tech 1.0?
Yeah, I mean, Clean Tech 1.0 really refers to 2008 to 2011, where we saw a lot of capital going in. And again, the money started moving to the more progressed ventures, but ventures that were really dependent on sort of economic signals that weren't sound. So we saw in the US gas prices collapse at that time, which changed sort of the reference point for some of those investments. In Europe, China started producing things like solar panels very cheaply, which meant companies like Qcell suddenly didn't have that unit economics that they believed that they had. I mean, I think we're also coming off the back of investors being very focused on SaaS plays. And as you said, suddenly in this space, we need to not just be doing software or AI, but doing deep tech hardware. We were chatting about that earlier. And that's where I think there are some other lessons just generally in how we build startups. So there's a lot of talk about an amazing scientist or a hero entrepreneur, but where we focus is on the team, and we think that the right team is actually catalytic. And one of our companies has been picked up, which is a great example of that, I think. We have two amazing technical founders from the University of Cambridge, but with a very experienced serial founder tackling a really hard problem.
I mean, touching on the topic of the hardware, I mean, Rahul, of course, your fund, 2150, you very much back companies in these more, let's say, regulatory heavy sectors like hardware, physical products. How do you really reconcile these venture timelines with deployment cycles that are very much, that can stretch beyond the typical fund size?
Yeah, that's a hard question. I think we reconcile it by being very clear about what venture is actually backing, what venture capital is being used for. I think we're not trying to back the kind of asset deployment, the building retrofit, the charger deployment, the kind of new industrial deployment. We're using venture to back the parts of the business that compound or have kind of asymmetric advantage. So the kind of the data layer, the customer acquisition profile, the business model innovation, and then I think we also need to be smart about timelines. For a fund like ours, we can't back businesses that need 8 years to figure out if they have a customer. They need to, we need to look at businesses that have, clear adoption, beyond pilots. They need to see, kind of some gross margin improvements over time. There needs to be kind of some clear signals that, this is a business that can kind of commercialize and scale.
Yeah. I mean, if we look on that timeline gap, that's pretty much where the P Capital Partners, your growth very much lives. So where do you see the boundary between what should be growth, credit, climate, and what belongs in the private equity or infrastructure? And if we look into the industry, do you really believe that some climate solutions simply do not belong to the VC side?
Thanks, Caritta. That's a great question. So what we really believe is that there's a funding gap, which we call the missing middle. So there's a lot of innovative companies that come out, first-of-a-kind technology that the VC landscape really can target and can really help them grow. And to what my colleague said, help them figure out an MVP, help them figure out pilots and kind of how they scale that business. Then you have where private equity infrastructure comes in, and we have a transition fund, which tends to be kind of already businesses that are well established, have a commercially proven, scalable model, and they want to go and are very cash flow generative. And then there's that gap of scale-up businesses that require high capex, because a lot of climate tech businesses do have physical assets. They have a proven business model, but they just need the next stage of capital to get to cash flow generative. And that's where we can really step in and help those businesses scale up and kind of attract that missing middle.
And I mean, earlier, I think what everyone here pretty much agrees that climate is pretty much the outcome. And we are already now, of course, seeing that you have, let's say, there's defense VCs, they're backing climate companies. We have more climate tech VCs that are backing, of course, on defense. And Patrick, on the ETF side, you have backed Open Cosmos. So it's this satellite infrastructure company, which very much could be said that it's a dual use company. So in your opinion, is dual use also becoming a real pattern in the deals that you're seeing right now? Or would you consider maybe Open Cosmos is more an exception to the case?
I think it happens from time to time that there's dual use. Frankly, it doesn't bother us. We're after a positive impact on the planet, and the companies can do other things as well. The company you mentioned, Open Cosmos, we invested in because it actually focuses on Earth observation, and of course that can be used for all sorts of things. But the primary applications are floods, fires, temperature sensing, things like that. And the demand is just huge. This company has grown about 8-fold in the past 2 years, right? And the rate of growth is accelerating, but it will only keep accelerating if it broadens its services, and so dual use becomes inevitable. And without it, we wouldn't get the same climate impact, actually. So we take a pragmatic view of it. And at the same time, defense is becoming a bit more systemic, right? So what is defense exactly, right? So And in a world of asymmetric warfare and asymmetric threat, it's natural that these ecosystems they're both engaged with reality and how to do things with reality. And so they're naturally going to converge to some degree. But we're not trying to become a defense fund for clarity.
Great. Nicky, maybe actually connecting to that question, when you look at these super early companies as well, do you have any specific criteria in your mind if we consider this dual-use defense? Because obviously it's very overarching theme on that. Or how do you view the companies before you invest?
Yeah, I mean, we are focused on impact. So we're SFDR Article 9, which is a whole other conversation, which is quite interesting. And actually, one of my bugbears in this space is when you bring in somebody external to try and assess the impact of a company. We have an opportunity, which founders are embracing, to really teach them about impact up front. But I have to be really clear on this. It's one of the reasons that I set up Carbon 13 was really to join the dots and have a pragmatic response. So that's impact not as a nice to have, but coming back to some of the things that all of us have been talking about, tying that impact to a commercial proposition. So energy efficiency would be a classic one, which I'm really excited by at the moment. Obviously, we've got pain points in energy, but talking about kilowatt hours saved is a very clear commercial proposition, but also a climate proposition. But it's really difficult. I mean, we could have a long conversation about how do you balance environmental versus social impacts, and it's tremendously challenging. I think the best that we can do is train people to have an honest view of these things and at least be transparent about what they're up to. But yeah, that is absolutely one of our criteria. We have to have additionality on impact in addition to those financial returns.
I mean, if we continue on that a little bit, when you do evaluate the companies, have you noticed any changes comparing today and let's say if you compare to last 2 years, especially when you're looking around the defensibility of the company? So is there something that you see that stretches beyond just typical patent, for example, IP, that you need to take into account when evaluating?
Yeah, and actually I think impact is exactly that. Look, I'm a scientist originally. I love the tech. I love the IP, the defensibility. But what I think is intellectually very interesting in this space is that dynamic commercial environment. And that is where we have a community of entrepreneurs on the front line. And that is where you can have defensibility by really understanding where those opportunities are. Another one of our businesses is a company called Caritta Earth. And they were the world's first carbon insurer, really trying to tackle some of the problems that we see in carbon credits. And they're now in an amazing position with incredible data sets and actually about to announce something else that they're doing. But yeah, again, progress very rapidly. And their defensibility, yes, partly data, but partly by being on the front foot in this space.
I think the discussion around defensibility is definitely very interesting with the current world order, if I may say, that we have. But Rahul, in your portfolio, you have pretty visibly, if I may say, moved away from the urban theme toward more like energy and industrial. So 1,5 is essentially, you could say, a household energy retailer. So has the urban thesis really become more like an energy thesis as of today?
Very provocative question, Caritta. I think I'd frame it a bit differently. I think energy has become like the most important constraint on the built world. And we're living in an AI revolution. Demand seems completely unlimited. Power is the only thing that's holding us back. And we invest in cities. Cities are where electricity demand, cooling demand, heating demand, mobility, industrial activity, all of this collides. So if we're investing in the built environment, we're inevitably investing in energy systems. That's how we look at it.
Perfect, thank you. In Reema, of course, at the P Capital Partners, you have multiple funds across the corporate, transition, and growth. But how does the growth fund enable the investments into climate tech? that the other funds do not? Maybe you can just talk a little bit more about these different funds.
Sure. Appreciate that it can be quite confusing. So when we think about growth, we look at businesses that are pre-profitability, pre-cash generation, very much innovative in that scale-up period that I mentioned is the missing middle, we feel, in terms of funding, especially for anything that's much more hardware or asset-heavy or has just fallen out of where kind of the investment flow is going. And so we can take those companies on. And what we like to do is, as the business scales, P Capital can scale with them. So if they start becoming much more of an infrastructure style asset, then they can move into our transition fund or a corporate credit fund, which tends to do more traditional direct lending. And then we are part of, as I mentioned, the M&G group. So if the business keeps scaling even further, then we have our parent company that we can introduce them to.
Perfect. And continue with a little bit more these disruptive topics, if I may say. We've already seen, of course, AI has disrupted everything, the way that we work and live. But if we look into how also it is shaping right now chemistry and materials, more on the climate side, I mean, you have one of your portfolio alumnus, Material Nexus. I think this is pretty much one of these bets, right? So Nicky, does the AI for materials, is it very much eating the next decade of climate deep tech, the way AI ate software? And what does this failure curve very much looks on the hardware climate at the pre-seed stage?
I mean, what I love about this business is, you know, and we're seeing this in energy at the moment, you know, a real energy transition. What we don't want to do is swap OPEC for a different set of concentrated control around some of these rare earth minerals, which is one of the tensions that we see at the moment. And Matnex have gone out there and said, actually, through this materials discovery platform, which historically has been really hard because to control for the functional properties, which is why you end up in a lab, but they have developed this magnet. So it's one of the first magnets since the 1950s. And they're picking up, and they've it was when I saw Jonathan, he had this jiffy bag in his pocket with this grey substance, and he was so excited about something that didn't look that remarkable, but that was them producing the magnet for the first time. So, and that's where I think it's really exciting. You know, a lot of people still have this view that hardware is really hard, it's difficult, it's in the name. But that's where AI, I think, is tremendously exciting. It can fundamentally change the trajectory of hardware development, and Matnex are an example of that.
Perfect. If we continue more on these disruptors, or let's say also change it that we see on the ecosystem. I mean, Rahul, if I start with you, the whole US political environment, we've seen how it has become more hostile towards the ESG labeled investing, if we're being completely honest. How much does these political risks also now shape where you deploy climate capital, or do you see it as a potential risk?
Yeah, no, I think it has a huge impact. I think we have been very conscious about not backing companies that have a kind of a single policy lever that drives adoption. You know, kind of policy and regulation is really important overall because it can impact demand, it can impact access to kind of procurement opportunities. So it is something to factor in, but the business model needs to make economic sense. I think the interesting thing is mainly for, I'm sure we're all thinking about this, is for Europe, because we have an opportunity now in Europe where climate focus, industrial competitiveness, energy security, all has collided and kind of come together at the same time. So there's actually a huge opportunity for the companies that we look at today. And the biggest risk that we have is execution risk, is like, you know, fragmented markets in Europe, you know, lack of enforcement of new regulation, lack of kind of consistent, you know, deployment of that regulation. So, you know, obviously the companies that we're backing need to have, you know, economic value first and clear value proposition for the customer. But I think Europe has now a big opportunity there from that perspective.
Patrick, are you aligned with what Rahul said, or is there something that you would like to add from your point of view when we're making these evaluations on the companies to invest?
No, I think we're all concerned with a practical positive impact that we can explain in plain language. And that's a different sort of world to the world of ESG, which tends to be about compliance with good internal practices. So yes, we like our companies to have good ESG policies and practices, but that's not why we invest. We invest for the outcomes and the impact the companies are going to have, and we need to be very real and grounded about that. And so, for example, if you look at our portfolio, we'll tell you what we think the impact of each is, hopefully without jargon, and we'll shy away from talking about potential gigatons saved if the technology is deployed globally. We did that 10 or 15 years ago, but honestly, the answers were always massive, and it just became ridiculous. And so we decided we needed real examples and case studies, and that's kept us, I hope, just grounded and practical.
I mean, now as we are moving towards very much the end of the panel discussion, I wanted to ask a question from all of you. Maybe we start with Reema. I mean, which climate subsector do you believe will produce the breakout European company in the next, let's say, 5 or a couple of years that you think this room or the people here might be actually overlooking? I know it's a tough one, but if you had to say something.
It is a tough one because I think we've touched on all the big, broad themes. But one area we spend a lot of time in is agricultural tech, which I think gets overlooked as a sector, especially around regenerative farming. We see Europe quite different to the rest of the markets, where consumers tend to be a lot more sustainable. They tend to look at their food practices a lot more, supply chains as well, and have a much more kind of broader understanding of being more farm to table. And we see that Europe can be a leader in that space and really reform the way agriculture is done.
Nicky, I know we talked earlier and you definitely touched the topic of agriculture. Is that something you agree, or do you consider there would be maybe some other subsector that you see it's very much going to surprise us?
Yeah, we did. We sort of touched on how do we best use the land that we have, and obviously that's a huge topic, and we see, you know, question marks over food systems and how we shift maybe from using land into bioreactors as an example, which I think is interesting. And there's a human behaviour element there, which I think is something that we need to be more focused on. You know, how do we provide the right incentives, affordable things when it comes to food, something that's really delicious and not just good for the planet and good for you. Yeah, but the other space that I think, you know, energy efficiency, it never sounds that exciting, but I think there are some tremendously exciting plays in there, from chemicals using less pressure, less temperature to create reactions, through to insulation in buildings, frankly. So, yeah, across the board.
Is that something, I know Rahul, you also talked about the energy, or you see some other sector that we haven't mentioned yet?
Yeah, maybe another one. We've been spending a lot of time looking at industrial intelligence for physical assets. So AI for optimizing factories, energy assets, infrastructure in real time. And there again, like, you know, Europe has this the potential now because it has its engineering talent, you know, industrial base, energy cost pressures. So there's lots of opportunity, I think, now in Europe to capitalize on that. We've invested in a few companies in this sector. One is called Carbon Re, that's, you know, optimizing cement plants in real time. But there are a lot of companies now innovating in this space using AI. I think this is a very exciting one.
Great. And Patrick, to close it up, what would you say as a sector?
Well, if I was really clear there was a specific sector that was overlooked and fantastic, I wouldn't tell you. Right?
That's the best answer.
That said, if you look at our website, you can see what we've done, right? And maybe there's answers in there. So we talk much more about the intelligence layer these days because we see huge impact through AI and digital technologies on top of modern infrastructure. But that's kind of obvious. If you look closely, you'll see we've backed a couple of satellite companies because we can see the economics of low Earth orbit satellites having profound impact on the planet. And if you look even more closely, you'll see we've just backed our second quantum company, which is a bit controversial because some would say, what's that got to do with climate? People keep trying to tell me what climate is. I keep trying to explain we're after positive impacts that our customers, our investors, agree are worthwhile, and we do believe we can accelerate the commerciality of quantum, and that will have massive impact. So space, quantum, other commercializing deep tech, I think will be the areas I would sort of generally point to.
Perfect. I think that was a great way to close up the panel. So thank you so much for all of the lovely speakers. Let's give a round of applause for everyone. Thank you.